I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading or simply algo trading. Today I'm going to talk about frequency analysis within the cryptocurrency markets. Most of the time when I talk about it, I tend to talk about it in the Forex market, but it has very much a place in the cryptocurrency market as well. In this case, I'm going to be looking at the CELO USDT pair, or CELO. Now, the one thing that needs to be stated with the cryptocurrency market is that your precision is always 8 digits on the default systems. And that's where we need to look at the market and fix that for our own analysis. So let's get straight to the screen and see what's going on. As we can see, everything is in 8 digits and you see 4 empty zeros at the end of the numbers. This is important because this tells you a lot about the order book right away. Even though the ticker has an 8-digit precision for this particular pair, the order book only records 4 digits. So this tells you immediately that the order book is strictly in a range or zone based analysis. So by pressing the 4 key, we cut out the unwanted digits and we look at only the first 4 digits. But even still, we can see that that doesn't provide as much granularity as we would like. And we can even refine it more. Now, this is a preferential basis, but for this particular pair, I prefer looking at a 3-digit range. I just find for analyzing it, it provides better information that I can correlate with. At the same time, the one thing you need to be aware of with this particular approach is it might be too aggregated into a single situation, where 4 digits might be better off. But as we continue to look at the chart, we can see that this order book is weighted on the sell side. That means there are more sellers than buyers. Now that is not necessarily good or bad. That's just the way this market is right now. So if you wanted to get into this market, and you have some CELO that you want to sell, then you have a good idea of where the price is by 59% of the market. Now, from the standpoint of wanting slightly higher prices, you actually can see just how high the prices can go and what an expected range might be. Again, the emphasis here is range. All of this information works in ranges or zones. The other thing that's important to understand is the lowest value of the range and the highest value of the range. And oftentimes with cryptocurrencies, this is set by the exchange as they want to keep the cryptocurrency assets in a very specific range of information. That is, they don't want offshoot numbers at 0 or 1 million. They want to keep it in a realistic approach. Let's go back to 4 digits for a minute and actually take a look at the market in a slightly finer grained approach of the order book. Now here we're looking at frequency weighting. That is, I have taken and collected 172,000 tickers and analyze the market from that data. And I have counted the frequency by which prices have gone back and forth for the last 48 days. Now this is strictly up to what you would prefer on the basis of your own risk assessment. I find this time frame does well for my own personal analysis. The more data you collect, though, the more storage you're going to need on your VPS. So there are considerations of just how much data becomes too much. But nonetheless, as we can see from this particular table, you have the count and the price. So we can see from here how many times a given price has appeared and what the highest point or frequency of that price is. For example, right now, the highest selling priced zone that the market is seeking is 0.7648. It's not significantly overwhelming compared to some of the other prices, as we can see from the frequency. But let's look at the volume. Where is the volume of the order book? So by pressing V for the frequency weighted order book analyzer, we get to the volume table. And now we can see actual volume. And you can also see some of the crazy numbers as well. People wanting it to go real low versus people wanting it to go real high. Now, cryptocurrency exchanges limit the range you can go. So there's only so far you can go with and without the range before things become problematic and the cryptocurrency exchange just stops it. So there are certain natural limits in the order book. But we can see somebody wants to drive the price all the way down to here, while somebody else wants to drive it way up to here. So this is really some of the fundamentals, and if you go in and out of the number of digits that you have within relation, you can see just how these numbers really transcend within certain physical limitations, including some people that want the price to simply go completely to zero. That is, they're betting this particular asset is going to fail. And you will have plenty of people that want insanely high values and some that want insanely low values. That's just part of the process. And as you continue to reduce precision, you can see more and more of this impact and effect within the order book, where the level of pricing becomes a factor of where people actually want this particular asset to go. It is important to remember that when you're looking at the order book at this level, you're looking at the pressure or tension between buyers on the left-hand side and sellers on the right-hand side. Buyers want to buy at a specific price, and sellers want to sell at a specific price. Subsequently, the pressure between them creates the back and forth motion. And by looking at where the first numbers are up here, you can see how close you are to a particular range. For example, right now, the market is in the 0.76 range. The highest selling pressure is 0.77 range. That means the market has more pressure to sell than to buy, which we already know from the frequency weighting that the market is sell heavy versus buy heavy. Now let's go back to 4 digits and actually take a look at the market in a more numerical approach. So here we see the 7642 range versus the 7649 range for the pressure of the order book. And we can see where that sits in relation to the numbers over here, with the largest pressure being buyers went in at a much cheaper rate than what the market is really willing to give. Now, putting all of this together is important because each component of this analysis plays a major role. The volume table shows you where buyers and sellers are wanting to get in and out of the market. Now, you can see that there are multiple levels of buyers and sellers where they pick the amount that they particularly want to get into. We can see from the frequency table that price has a correlation with the number of times it has been seen in the market. That is, how many times has 7649 been seen? Well, that is 7 times. 7648 has been seen 16 times. Statistically, where price has been seen is where the model of the market is most likely to return to. Now, this is not a perfect representation of the market, but it is sufficient enough for a ranged level analysis that we begin to realize where the buyers and the sellers are actually at. The frequency table tells you where price has been and where price could potentially return to by a probability. The weighting table, that is the actual weight or the combined values of the volume table and the frequency table. This gives you an overall rounded look at the market. And we can see that the sell side has multiple high levels. For example, 7652 is 15% of the market. And now we see even multiple levels. You're going to see these fluctuations quite extensively as the market grows and shrinks due to buyer and seller demand. And we see that the buy side equally has multiple zones of people that are interested. Now, the point of reference to pay attention to is your bid and your ask in relation to the buying and selling pressure. Right now, the pressure looks to be reasonably equal, but it still shows, if you add up the numbers under the weighting column, more pressure under selling. And this is where the aggregation of less digits can help make this job easier. For example, with 3 digits, we can clearly see a better picture than 4 digits. And right now we can see that the 764 range accounts for roughly 68% of the entire selling market. And 763 represents roughly 54% of the entire selling market, but it fluctuates dramatically. So by watching the market, we can see where the pressure sits, and we can see where the support levels are and resistance levels are within the market based upon the actual buys and sells going on within the market. Now, if you've noticed, I've deliberately avoided using bulls and bears and kept this in relation to buyers and sellers. I think sometimes using bulls and bears often confuses the terminology of the market with order book analysis, when really it's just a matter of buyers and sellers. Buyers want the price on the left, sellers want the price on the right. Bears want the price on the left, bulls want the price on the right. You can use them interchangeably to some degree, but it can get confusing. So I've tried to keep that for this discussion very simple and just focus on where the buyers and the sellers want. Now, there are multiple levels of strategies that can be used here to help you gain insight in terms of where you should actually place your buy orders or your sell orders, or even how you should manage something like a grid trading process. For grid trading, you have the order book providing you with a natural level of grid zone expectations. You can see within the grids automatically set up by the order book should you choose to follow their approach. And you can see mechanically what they expect to be a pressurized system, meaning you know where your orders are likely going to go from point to point, and you can see that right now it looks like the market is going to be moving downward. so a short selling technique might be advisable for this situation. If you are looking for a longer term approach though, then you might want to look at a more aggregated area to see where the market is going to go. And it's important to understand that the more aggregated you are, the longer term you become. So the longer your expectations are going to be for being in the market itself. For example, here we can see where the market is in relation to pressure between buyers and sellers on a larger overview approach. And we can see from here where we need to really look at the market in terms of actual depth, volume, and trading activity. So by zooming out of the market with such detail, we can then gain knowledge about where we need to be within the market as a whole in relation to the last 48 days. The last 48 days has a very high concentration of prices within the 0.76 range. That is critical because now we have a functional equivalency of exactly where we need to focus our bot. How do we need to actually look at the market? So whether you're using Forex or cryptocurrencies, order book analysis is a critical component, and that component should not be ignored. There are a lot of different bits of information stored here that are just openly and visibly critical to your trading success. As you progress with using order book analysis though, you must be aware that you are dealing with zones and ranges at all times and under all circumstances. Every order book uses aggregated information in order to be meaningful. Leave me a comment. Let me know what you think. How does order book information help you? If you have any questions, please feel free to ask them. Please give this video a like because it does help me with the YouTube algorithm and it does help this channel grow. Thank you for watching.